Could we be nearing the end of rising interest rates? And if so, what does that mean for the economy and the market? Hello again, I'm Scott Inman with this week's fastest 4 minutes in finance. Well, the Federal Reserve this week raised the federal funds rate by 1/4 percentage point, which puts the short-term borrowing rate now at between 4.75% and 5%. But there was also a shift in the message that is leading economists to believe the rate hiking cycle is coming to a close. Along with this week's announcement, the Fed also released updated economic forecasts, which included what is called a dot plot. Now that basically maps out the policy expectations for the rest of the year. That guidance showed the majority of Fed members believe interest rates will top out at 5.1%. There was also a significant change in language in the Fed announcement. Chair Jerome Powell is no longer saying things like ongoing rate increases and now says that, quote, some additional policy firming may be appropriate. Market expectations were for a less than 0.5% hike and perhaps even no hike at all following the failures of a handful of regional banks, which was due in part to rapidly rising interest rates, in addition to the mismanagement of those banks. The Fed did address those bank failures and is trying to assure Americans that the banking system is on solid footing. It's not just the rate hikes that have created the banking havoc, it is the pace in which they are happening. This week's rate hike is the 9th consecutive hike over the course of the past year. Now, to put that in perspective, the last time the Fed raised rates for an extended period of time, they also instituted 9 hikes, but it was over a 3-year period. It's been 3 years now since the U.S. government shut the economy down over concerns about the COVID-19 pandemic, and really everything economically that has happened since has happened in a collapsed time frame compared to a normal economic cycle, including a rapid rise in interest rates. The latest news by the Fed may indicate that a return to normal is close. Now, that doesn't mean that we will avoid a recession. It could mean, though, that the recession might be short-lived. As far as the markets are concerned, investors have been waiting for good news for a long time, and they have lots of capital to invest. A record high $5 trillion is sitting in money market funds. There is a good chance that investors decide to redeploy some of those funds into stocks at some point. Markets initially dropped on the Fed announcement on Wednesday, but shot up the next trading day after digesting the news on a deeper level. Market volatility is sure to continue in the next few months as the economic data continues to bob us back and forth like a yo-yo. But there is growing optimism that at least the policy decisions are leaning a more favorable direction, and long-term, the stock market has a lot of potential. Thanks for watching.